Good afternoon, everybody, and welcome to today's webinar. We're going to give everybody another minute or two before we get started, so hang tight. Good afternoon, everybody, and welcome to the latest installment of the Stow and Degon webinar series. Today, we're going to talk about the One Big Beautiful Bill and what it means to your 2025 taxes. I'm Marty Croyle. I'll be the moderator for today's session, and in a moment, I'll introduce our panel. Uh, Some of you may have attended our first webinar about the Big Beautiful Bill back in August, but we thought it would make sense to redo it because there's been some changes, some clarifications, and we're going to address all that today. Webinar attendance guide. So there'll be Q&A. Questions are deeply appreciated. You can type them in the Q&A box down below. And if we run out of time at the end of this program, which ends at 1 o'clock, we will get back to you either by phone or by email. The presentation is being recorded, so you don't have to madly scribble down everything. You can watch it again at your own pleasure, or you can show it to other people in your company. And in another day or two, it will be on our YouTube channel, and the address is on the screen. After the presentation, we will send you a survey. There are two things that are important to us. One is how did we do today? And the second is suggested topics for future webinars. So if you could look for that survey, please fill it out and send it back. Next slide. Disclaimer. It's December 11th. We're going to tell you what we know as of today. And as you all know, that things do change in this world of ours. This also doesn't serve as a personalized consultation for your particular situation. So we strongly recommend that you use these talking points today as an overview from 40,000 feet and reach out to your legal or financial advisors for any additional help, and always feel free to contact anyone at Stow and Degon. Today's speakers will be you all know Prasanna Kantambi and Mary Donata. She's been on programs in the past, and our newest senior tax manager, Kevin Tinsley, will be also involved. Kevin will start. And so for the next 30 or 40 minutes, we're going to talk about individuals, the impact on individuals from the One Big Beautiful Bill. And Kevin's going to start. He'll hand that off to Mary, and then we'll slide over to the impact on businesses. Mary will turn the program over to Prasanna, and when Prasanna's done, he'll turn it back over to me, and I'll coordinate the Q&A. So, Kevin, welcome, and you're on.
Thanks, Marty. Hi, everyone. Thanks so much for joining today's webinar, One Big Beautiful Bill. Over the next few minutes, I'm going to break down what this new legislation means for individuals, especially when it comes to taxes and deductions. Keep in mind, I'll be presenting some changes that impact 2025 and some that don't take effect until 2026. But some changes in 2026 might lead to planning opportunities now. So first up, some big ticket items. Several provisions from the Tax Act and Job Act are now permanent. That means the top individual tax rate stays at 37%. It was scheduled to increase to 39.6% in 2026. AMT exemptions, alternative minimum tax exemptions, and thresholds remain in place. The child tax credit gets a bump from $2,000 to $2,200 per child. It phases out at $400,000 for joint filers and $200,000 for others, and it will be indexed for inflation. And here's something new: a $6,000 personal deduction for seniors, available from 2025 through 2028. But keep in mind, it phases out at $150,000 MAGI for joint filers and $75,000 for singles. Married filing separately, there's no deduction here for child tax credit. And I mean, for the $6,000 personal deduction for seniors. Some phase outs are calculated using adjusted gross income, AGI, which is line 11 on page 1 of your federal tax return. And others use modified adjusted gross income, which I talk about as MAGI. MAGI starts with adjusted gross income and is modified, for example, by adding back tax-exempt interest, deductions for IRA contributions, and a few other items. Okay, next slide. Let's talk about the SALT deduction. State and local taxes are getting major changes. The cap jumped from $10,000 to $40,000, and it will be adjusted for inflation. Now there's a catch on this. Phase outs start at $500,000 MAGA, and the cap reduces to 30% for income above that. So if you're under $600,000, this is relevant. One more note though, the cap goes back to $10,000 in 2030. So enjoy it while it lasts. Although this increase in SALT tax deduction is a nice addition, partnerships and S corporations still need to consider electing to pay state income taxes at the entity level, preserving the deduction and avoiding a SALT phase-out trap. Next slide, please. Mortgage and car loan interest. Mortgage deduction. This is still capped at $750,000 of debt, but now it's made permanent. Home equity loans are included in this $750,000 cap, but only if that home equity loan is used for substantially remodeling or improving the home secured by the loan. Starting in 2026, mortgage insurance premiums will count as interest, but with phase-out limits. And there's something new now, a car loan interest deduction, but it's only good for 2025 through 2028. It's an above-the-line deduction, up to $10,000. The loan must be secured by the vehicle, used for personal use, and for a new car that meets the Made in America rules, which basically means it's been assembled in America. Phase-out thresholds, $100,000 for single and $200,000 for joint filers. And here's a takeaway. If you're planning a big car purchase, timing might matter now. Next slide. Okay, charitable. In 2025, the above-the-line deduction comes back to $200. It comes back to $300. In 2026, it jumps to $1,000 for singles and $2,000 for joint filers, but only for non-itemizers. Now, starting in 2026, there's a 0.5% adjusted gross haircut for your deductions. So bunching contributions or front-loading to 2025 might be smart. Consider using a donor-advised fund in 2025. That will allow you to grant the contributions over time. In Massachusetts, there's no deduction allowed for used items like Goodwill or Salvation Army. Next slide. Overall, there's a haircut for itemized deductions. For 2026 onward, if your income exceeds the highest tax bracket, there's an overall haircut on itemized deductions. The formula is 2/37, or about 5.4%, applied to the lesser of your itemized deductions or income above the threshold. So here's an example. If you have 120,000 in itemized deductions, you get a haircut of about $6,486, leaving your itemized deductions of $1,113 left. Next slide, please. Miscellaneous deductions. They're still suspended. That means no tax prep fee, investment expenses, or union dues. In employee business expenses, they're still not deductible. But casualty losses make a comeback in 2026 for both federal and state declared disasters. But they're subject to a reduction of $100 and another reduction of 10% of your adjusted gross income. Next slide. And finally, educator expenses. In 2025, the above the line deduction stays at $300 per person. In 2026, it goes up to $350. And there's a new miscellaneous itemized deductions with no collar cap for itemizers. Eligibility expands to sports administrator and coaches and more. So in closing, there are some big changes and they impact planning for years to come. Some key takeaways. The SALT deduction will increase. New car loan interest, that's new. There's a haircut to charity and then overall itemized deductions in 2026. That means bunching your deductions in 2025 might be a good planning opportunity. So now I'll turn it over to Mary, and she will expand on some other provisions of the bill.
Thank you, Kevin. Hello, everyone on the call, and once again, thank you for joining us. I'm going to continue with some of the exciting changes that have come from the big, beautiful bill, along with some quick tax planning advice for individuals. The first two provisions I'm going to talk about are the various items which President Trump campaigned on, tips and overtime. In 2025, a new tip credit has come into place. This is only for the 25 through 28 tax year. It is exactly like what it sounds like, a credit for tip wages. However, these tip wages fall into 8 categories or industries which have been determined by the Internal Revenue Services. Examples you will find include bartenders, waitstaffs, bellhops, dog walkers. Those are just to name a few of the job types that fall in these 8 selected categories. The tip has to be paid in cash. Cash is exactly what cash sounds like. Cash, credit card payments, gift card payments. Items like lottery tickets, Celtic tickets would not qualify. The tip has to be volunteer. It has to be voluntarily. What that means is the tip is not required to be paid. An example would be in the restaurant industry, a restaurant server serves a party of 6 or more, and a 20% tip is required to be paid for the service. That tip does not qualify for this credit. This is an above-the-line deduction of up to $25,000, which has a phase-out of $150K for individuals, $300K for joint filers. Just would like to point out that $25K is per return, meaning a joint individual where both husband and wife work in the restaurant industry would be subject to the $25K limitation. It would not be $50K for them. This is not available for those married filing separately. The tip exclusion does not apply to owners. However, there is an exception for Schedule C filers who receive a 1099, which includes a tip. In 2025, there is no official recording requirement on the W-2. However, the service is highly suggesting that employers try and report the information in Box 14. In 2026, we will find that the W-2 does have 2 new boxes. One to report the code for the industry where the employee works, and another box to report the amount of tip received. we are highly suggesting that companies who are subject to reporting tips put into place a process to keep track of these amounts if there is not one in place. And this would also apply to overtime pay, which is up next. So right now there is a new overtime credit, and this is another credit which President Trump campaigned on. Just like the tip credit, it is a short-lived credit, only available for the 25 through 28 tax year. This credit is up to $12,500 for individuals, $25K for joint filers. Overtime may not be what you think it is. Overtime must meet the Fair Labor Standard Act definition. So you'll find that most salary individuals do not qualify for this credit. And you'll find that some individuals receive an overtime. It is not because of the Fair Labor Standard Act law, but due to state tax law. An example of this would be small farms are exempt from paying overtime under the Fair Labor Standards Act. However, under Massachusetts law, overtime is required. Thereby, this overtime would not qualify for the credit. There are other examples of computer programmers who are paid over $27.63 an hour. Under the Fair Standards Labor Act, they are not required to be paid overtime, but you might find the employer is paying overtime to be competitive and to secure help. This would not qualify for the credit. Now, what exactly is the overtime that the credit does apply to? It applies to those individuals who meet the requirements, who are paid 50% higher wages on a work week, which is more than 40 hours. So what does that mean? An example would be an employee who is paid $20 an hour and works a 41-hour work week. They have worked 1 hour of overtime. The amount of overtime which is allowed under the credit is $10, not the $30 which has been received. This credit is subject to a phase-out range of $150K for single individuals, $300K for joint filers. This is also not available if you file married filing separately. There is no official box on the W-2 this year to report these amounts. The IRS does have suggestions on determining this amount by looking at your pay stub. In 2026, there will be an official box on your W-2 where this amount will be recorded. I want to point out the United States Labor Department does have a wonderful website which has great fact sheets on which employees are required to be paid overtime under the Fair Labor Standards Act. Next page. Next slide, please. Oh, the adoption credit. So wonderful news for those who are adopting an individual, adopting a child. There is a $5K refundable credit which has been put into place. Big changes have happened to the 529 account in 2025. For the kindergarten through grade 12 range, it has been expanded. The annual limit has increased from 10K to 20K per beneficiary, and the type of expenses have been expanded to include books, online materials, fees. You will also find that qualified post-secondary credentialing expenses now qualify to be used from the 529 plan. Next slide, please. Clean energy credits. Unfortunately, these have either gone away or will be going away by the end of December. Those credits for vehicles have gone bye-bye as of September 30th. And as of December 31st, the home energy credits will be caboose. But you still have a couple weeks to get in those windows to qualify for some of these credits. The estate tax exemption has been permanently increased to $15 million starting in 2026. What I will say about estate planning is if you do not have a will in place, to speak to a lawyer, get one in place, the best thing you can do. Next slide. Nothing really happened in Massachusetts. A new law has come into place for those owning real estate in Massachusetts who are non-residents and have sold that piece of property. They will be subject to withholding if their sale price of the property is more than 1 million. This is intended to make sure that those individuals do file a tax return to pay their taxes on those sales. The surtax has been indexed for inflation. That's the millionaire's tax. You will not be subject to the millionaire's tax unless you have reached $1,083,150. Next slide. Oh, the next slide is the executive order from President Trump. And most people will feel that this does not apply to them, but we will find as I go through this, it applies to everyone. The executive order stated that the U.S. government, as of September of 2025, will no longer issue paper refunds or accept payments for bills by check. And this applies to everyone who files a U.S. tax return. Thereby, your refund cannot be received by paper, and you cannot pay your IRS bill by check. So you will need to provide your tax accountant with your routing number and your bank account number to receive your refund electronically. And if you owe money, you will need to pay via the same route by providing your tax provider with your routing number and your bank account number. So it's electronically taken from your tax return when it's filed. Or the IRS does have some wonderful links on their website where you can make payments. And I do suggest that everyone look at those, look at the IRS website for those provisions. There are supposed to be exceptions to these rules. We are waiting for the IRS to officially provide the list of people who are exempted. We expect these to be individuals who may not have access to banking, incarcerated individuals, elderly individuals, people who may be in a disaster area. So we are still waiting guidance from the IRS on this. Next slide. The retirement provisions, the 401k and the 408, 403b plan limitations are $31,000 if you're over 50 for the 2025 tax year. You're able to contribute $23,500. If you're under 50, the IRA for 2025 is $7,000. Catch up is $1,000. There's a super catch up for the 60 to 63 age range. Roth limitations are still in place. SEP the SEP IRA will fluctuate based on your income. The 2026 tax year, these have really just gone up a little bit. Do suggest that everyone, if they can, try and do the maximum amount to these retirement plans that you have in place. Next slide. So year end, lots of things to think about when you're tax planning. And the first one would be to try and harvest losses if you have gains already this year. Cryptocurrency losses, of course, are not subject to the wash sale rules. To maximize your pre-tax deductions, which we quickly just talked about on the previous slide, to contribute to charities. Consider Roth conversions, especially if a Roth conversion will keep you in the same tax bracket. and to make sure your required minimum distributions have been taken by year end, because if you don't take them, you could be subject to penalties. I am now going to turn this over to Prasanna, who is a tax partner at Stowe and Deegan and head of the tax department. Thank you.
Thanks, Mary. Thanks, everyone, again, for taking the time to attend this webinar. We'll talk about some of the business-related items in the One Big Beautiful Bill. We haven't covered everything that's there in the bill, but we're trying to talk about all the important things. But if, like, you guys have kind of read some articles or heard something that you want to discuss more about, just feel free to call us anytime. We are happy to help, happy to talk to you about how everything pertains to your specific situation. The first thing to talk about here is the qualified business income deduction. The qualified business income deduction, if you guys remember, I've talked about this multiple times in the prior webinars, but I'll talk about it a little bit more currently, just to give you a little bit more background here. The qualified business income deduction was put into place in 2017 when the Tax Cut and Jobs Act was passed. You remember how they reduced the corporate tax rates from 35% to 21%. So they wanted to do something for flow-through businesses as well. So what they came up with is this qualified business income deduction. So if, like, let's say an S Corp or a partnership makes $1 million, what typically happens is that the $1 million flows through to the individual, and the individual pays tax based on their pertaining tax rates. What this qualified business income deduction does for you is it kind of say, based on the amount of payroll that's there in the company or the amount of hard assets that the company has placed into service, that they might be eligible for a $200,000 deduction at the individual level, though the determination of how much the deduction is going to be done is done at the entity level. So now, instead of paying tax at the $1 million in my example, you pay tax on the $800,000. So it effectively reduces your effective tax rate if on the profits of the business. They did carve out certain industries from it. They called it the specified services, accountants, attorneys, management consultants. They all kind of fell into this category. And these people were allowed a deduction only if their income was below a certain threshold. What the One Big Beautiful Bill has done is now made this qualified business income deduction permanent. What does permanent really mean? Just to kind of deviate a little bit, it really only means that there is no time-based expiration. What it really means is that it's permanent unless Congress decides to change it again. So nothing is really permanent. Everything is temporary till the next person decides to change it. So going back to this, they've kind of increased, they've not only made this qualified business income deduction permanent, they've also tried to make it slightly easier for some of those specified services that we talked about, like the accountants and attorneys, to claim advantage of this deduction by increasing the threshold. They haven't increased it too much, so I don't think a lot of people would still qualify, but they have made some increments to it. They've also put together a new deduction for taxpayers with a minimum income of $1,000. There's a $400 deduction. But again, overall, I think from a One Big Beautiful Bill standpoint, the qualified business income deduction continues to be there, and it continues to be even more favorable than it was as a part of the Tax Cut and Jobs Act. Next slide, please. The other thing to keep in mind is the depreciation rules. The depreciation rules are even more favorable in the One Big Beautiful Bill. The Section 179 expensing, the limits have doubled from last year. Last year, it was around it was supposed to be $1.22 million for 25, and now it's up to $2.5 million. It does begin to phase out once the additions for a business is more than $4 million during the year. This change does expand the eligibility, allowing more small and mid-sized businesses to immediately expense the full cost of equipment, vehicle, and software up to these limits. The other good thing about Section 179 is that most states conform to the 179. So usually when you have a federal deduction, you also have a state deduction at the same time. In fact, Massachusetts does conform too. So it'll be both a benefit from the federal and the state standpoint. Second, the bonus depreciation was going to be 40% this year without the One Big Beautiful Bill. Now they've permanently put it back to 100%. It's only for assets placed in service after January 19th, 2025. I think that's the date the president was sworn in. So that's the date they've kind of started the 100% from. These enhancements, I think, are going to make a big difference for people to be able to write off their capital improvements and overall reduce their taxable income and reduce their effective tax rates. The next important topic is the R&D expenses. This impacted a lot of our clients. What really happened is when in 2017, when the Tax Cut and Jobs Act was passed, in order to create some revenues in the future, what they did was they said from 2022 onwards, all R&D expenses will have to be amortized over 5 years. 5 years for domestic R&D and 15 years for foreign R&D. Nobody thought that this rule would stay because IRS itself didn't issue any guidance on it for over 3 years. But nothing was getting done in Congress. So this has been in place since 2022, which makes it extremely disadvantageous for the companies in the United States to be performing R&D because they're not getting immediate value for their expenditures, as they're not able to write it off. So that increases their effective tax rate. So what this One Big Beautiful Bill has done is try to fix it. There has been a lot of pressure on Congress to fix it for the past few years. So the One Big Beautiful Bill has finally done that. But the way they've done it is slightly different for smaller businesses and larger businesses. For smaller businesses, the way they've defined smaller businesses is if your revenues are less than 31 million, average of 31 million between 22, 23, and 24. So if that's the case, then what happens is you have 4 options. The first option is you can go back and amend your 22, 23, and 24 return and expense all of those R&D expenses right away and try to claim a refund. The other option for people, not everybody likes to amend the returns. The other option is to take all the deduction in 2025. But if you have such a large amount of unamortized amount, you might not really get the benefit of it if you expense everything in 25. So they've also added in a provision whereby people can spread out the deduction between 25 and 26, whereby they can take 50% in 25 and 50% in 26. And also the fourth option is to just leave the 22, 23, and 24 and let it amortize over its remaining life. Some people, again, I think everybody's situation is unique. So far, I've already run into all the 4 situations being applicable for different clients. So it is something that has to be looked at on a client-by-client basis to see what makes sense for them. For the larger businesses, they don't have the option of going back and amending 22, 23, and 24. The only option they have is to either take the deduction in 25 or spread it out between half and half in between 25 and 26, or just continue with the amortization. But the overall good news is going forward from 2025 onwards, no amortization. Everybody will be able to write off their R&D expenses right away. Next slide, please. The other thing that I want to talk about, which is I think very important, which is not being talked about enough, is a newly codified Section 168, subsection N. What this is essentially trying to do is bring back manufacturing to the United States. So if you started building a new manufacturing facility between 2025 and 2029, and if it's placed in service before 2021, the real estate cost associated with building that manufacturing facility could be depreciated right away as a bonus depreciation. So let's say you build a facility for $5 million, it's 100,000 square feet. let's say 20,000 of that square feet is for office and administrative purposes, but the remaining 80,000 square feet is for the manufacturing floor. So now you attribute out of that $5 million that you've spent, you attribute $4 million of it being spent for manufacturing facility, and you can write off right away that $4 million as a bonus depreciation. So I think that's a huge benefit. I think a lot of manufacturing companies are going to benefit from it. One thing they do need to fix in it is the way the bill is written right now. The manufacturing entity or the operating entity has to buy the real estate in order to take advantage of this. Normally, most often, what happens is when business owners are buying real estate, they're usually buying it in a separate entity than from the operating entity, just to kind of protect themselves from liability issues. So I do think that this will get fixed eventually through some sort of a technical corrections. But right now, the way the bill is written is that the operating entity will have to buy the real estate. Next slide, please. Actually, you can go one more slide. They both were the same. The other one is the Tax Cut and Jobs Act put into place a new section called 163J. What the 163J did was it said for larger businesses, initially they would be eligible for interest expense deduction only up to 30% of their EBITDA. From 22 onwards, that EBITDA changed to EBIT. So what that meant is that people were not able to add back depreciation and amortization in order to calculate the amount of interest expense that they could deduct. For many capital-intensive companies, that dramatically reduces the amount of their interest deduction. The OBBA, again, I think there was a lot of lobbying against this, so the OBBA kind of fixed that problem. So they've put the formula back at 30% of EBITDA. So that will help companies take more deduction of their interest expense. Next slide, please. There were a few, like I said, that we didn't talk about everything in this webinar because we didn't want to we wanted to stick to an hour. We wanted to give people enough opportunities to ask questions, but there are a few other important things that I'll try to kind of quickly touch upon. I think we've gotten a lot of questions on the Trump accounts. I do think that there is going to be some more interest on it. I think we're still waiting on more clarity on how everything is going to work. It doesn't officially start till July, doesn't start till July 4th of 2026. Individuals will be able to contribute after-tax dollars into it, and all future earnings on that will be tax-free. So it'll be similar to another Roth IRA account. So there might be some benefit in kind of looking at the Trump account, but it's still kind of a little too early to talk about it. The OBBA also significantly enhances the Qualified Opportunity Zone program to stimulate long-term investment in distressed communities. If you have a significant capital gain during the year, you might be able to defer some of this gain by investing in these distressed communities. If you hold the investment long enough, there are basis step-ups. There is a certain amount of tax-free growth appreciation, or if it's held for 10 years. So again, we are happy to talk to anyone about it if people are interested in knowing more about it. It usually works if you have a significant capital gain in a year. The other thing to know about is the qualified small business stock exclusion. They made these rules even more favorable, where you'd be able to take a right, exclude up to 100% of the gain from a stock if held for more than 5 years. They've also prorated stuff. So if you held the stock for 3 years, you might be able to get a 50% gain exclusion. Again, these can be separate topics on its own in a different webinar that we'd be happy to talk about. But if anybody has questions, please feel free to call us anytime. With that, I'll hand it back to Marty.
Thanks, Prasanna, Kevin, and Mary. Great job. We've got some time to take some questions. So if you have any that you'd like to type in the Q&A box, that'd be great, and we'll get to them before we finish at the top of the hour. But I have a couple of questions here. One is, will I be receiving a 1099 in 2025 for the sale of some cryptocurrency I have?
I can answer that. Yes, in 2025, 2025, you will be receiving, I think it's called, I'm not too sure exactly the form, but it is a 1099. The whole thing may not be filled in, but you will be receiving it. And I just want to point out that if it's a lot, you may be red flagged by the IRS of why all of a sudden you're getting all these 1099s if you never reported any sales of cryptocurrency in previous years.
Hmm.
So this may be something to have a conversation with us about if this does apply to you.
Great. So the 1099 is brand new in 2025, right?
Correct.
Right.
Can I just add one more thing to
Sure.
it? I think just for people to be aware of the issue, you know how there is a rule to issue 1099s to somebody for above $600. That's rules been there for that $600 has been unchanged for like since I've been in public accounting, which is over 25 years. I think that amount in 2026 is going from $600 to $2,000. Just something for people to be aware of.
And to clarify a little bit more, that's for the 1099 miscellaneous
Miscellaneous,
NECs.
yes.
Okay.
Great. I receive tips from a tip pool at work. Will I get a tip deduction for these tips that I receive?
I can answer that one too. And no, you will not receive, unfortunately, the tip has to be to a specific person. It has to, as I indicated before, it has to be voluntary and it has to be to a specific person. And usually that's to your server.
I would imagine it's going to be difficult for the restaurant people to keep track of all this.
Yeah.
Yeah.
I mean, I think the IRS is cutting businesses some slack in 2025 with regards to reporting of these tips and overtime. They are trying to say, let's do a reasonable method in 25, but from 26 onwards, employers have to figure it out. Businesses have to figure out a good process in place to track all these tips, track all this overtime. So businesses need to be, I'm sure, like the payroll service providers are going to be able to help as well, but something to be aware of.
Great. What potential tax limitations do I need to be concerned about if I start bunching charitable deductions in 2025 that you talked about?
I can take that one. So I think for cash contributions to public charities and private foundations, there's a 60% limit of adjusted gross income. And that was set to expire in 2025, but now it's made permanent. But so if you have non-cash contributions, those are subject to other types of limits. It could be 50%, 30%, 20%, depending on the type of property in the organization that you're donating to. I'll give you an example. So if you're donating gift of capital gain property, that's generally limited to 30% of adjusted gross income, unless you elect to forego the full value of that stock, for example, and just use the cost basis. So if you use just the cost basis of your stock, you could get a 50% deduction on that. And then the good news is if your contributions exceed those limits and you have carryover, you can carry those over to 15 years. So you can plan to get the deduction at some point. And then another thing to note, if it's a non-cash contribution and it's over $5,000, you might need an appraisal done of that contribution to ensure that you have a valid value for that item.
So it's pretty complicated. So they ought to call Stow and Degon if they are planning on making some big donations, huh?
Yeah, I think so. I think you got to plan it properly, definitely.
You mentioned that in Massachusetts was no longer a deduction to like goodwill for used goods. Is it still a deduction at the federal level?
Yes, of course.
Yeah,
Okay.
it falls into those non-cash contributions limits. It's just on Massachusetts. Massachusetts allows you to have a charitable deduction now off of your income tax return, but it's just for cash items, not for those goodwill or Salvation non-cash items.
Here's one on homeschooling. My child If I homeschool my child, can monies be taken from a 529 plan to pay for supplies?
I can handle that one. Yeah. That's the great thing about the changes from the big beautiful bill. Um, it expanded the expenses that can be used from the 529 plan, and those include school supplies for those who are homeschooled. Yes, so it will apply.
Okay. Any rules on the type of car, electric or gas, or size of car that would limit the interest deduction?
Sure, I can take that one. So I think you can have an electric vehicle, you can have a gas powered vehicle, you could have a hybrids, you could have a motorcycle. All of those can qualify under the requirement. The only issue is you can't have anything with the gross vehicle weight greater than 14,000 pounds. Uh, and one thing to note, when you're trying to determine whether it's manufactured in America, that's the key to the made in America, whether it's assembled or not. Um, you can ask the dealer you're buying from, but if you really want to know, there's the Highway Traffic and Safety Administration has a website, and you can put the VIN number of that vehicle in there, and they'll tell you where it's been assembled. So you'll be able to, totally verify that this will qualify for that interest deduction.
Have you seen that website yet?
I haven't seen it
I
yet.
haven't either. But that would be a safeguard if
Yes.
you're planning to do this yeah, okay. That's good to know. Couple others. You guys mentioned uh, some of these provisions are between 25 and 2028, or in one case, there was something about 2030. We seem to go through this whenever we do these laws. Can somebody just do a quick overview of why these things sunset and why they sunset so soon?
Yeah, so I think when the Tax Cut and Jobs Act was put, right, the first time, they it was part of the, like, they have to do it as a part of their appropriations where they cannot let the debt exceed above a certain threshold. So they have to put some, like, they usually look at a 10-year window for it. And so if they're creating something that's generating revenues, or if they're expending money on something that's creating or increasing the debt, they have to create revenues to go along with it. So that's why, in order to kind of manage the debt to not go above a certain threshold, they have to have certain things sunsetting uh, more. So they try to kind of figure out which are the less important ones and try to get those to sunset, and which ones they want to make permanent.
It's kind of a big math game, huh?
It is.
You guys were mentioning capital loss harvesting, which I've heard of for sure for a long time. Can you just somebody briefly do what a wash sale is?
I can do it. I think what a wash sale essentially does is, let's say, let's say on December 30th, you hold a stock at $1,000 loss. So you decide to sell it on December 30th and take that $1,000 loss on your personal tax return. What wash sale tries to avoid is that you don't go back on January 2nd and buy it back again. And the only reason you really sold it was to take the loss. So wash sale tries to say if you kind of sold it 30 days before or after, like the sale, the last sale, then you need to kind of disallow the loss till you kind of sell the second lot that you bought again, which is what wash sale is trying to do. Usually the brokerage custodians themselves do a good job in trying to kind of track the wash sale. What they cannot do is, let's say you have some money in JP Morgan, some money in Fidelity, then you're not going to be able to keep track of that wash sale. So sometimes it's good to kind of keep a lot of the accounts with one wealth manager so that they can kind of track the wash sales a little bit better.
So did you say how long a delay before you can repurchase that
You
same
you
stock?
you have to let a 30-day window pass
30
since
day?
the
Okay.
yeah the sale. Yeah.
And I can add one thing to that
Sure.
is uh, you've got to be careful. Some clients or try to use their retirement vehicle as a way to buy back those shares, and that's still disallowed under the wash sale rule. So you can't sell in a brokerage account and then buy it back in your IRA account and try to avoid the wash sale rules.
Got it. I have one more question here. In the car loan interest and the charitable conversation, we talked about things being above the line deductions. Can someone briefly explain what above the line deduction means?
I can take that. I think what we're trying to say is that it will be a deduction from your income before you get to itemized deduction. So it doesn't fall into that itemized deduction bucket where you might get limited in the future by a phase, a limitation of your itemized deductions, that 5.4% figure that I talked about earlier. So it comes right off of your income, as opposed to being part of a decision whether you itemize your deduction or whether you have a standard deduction. So it comes right off your income.
Got it. Thank you. Prasanna, Mary, or Kevin, we've got a couple more minutes. Is there anything else any of you would like to say or have a new thought about adding here today before we say
Yeah, I mean,
goodbye?
I will just say that again, everything we talked about, I think we've said it a few times, but it's just in general terms. We just wanted people to be aware of what's going on and what are some of the things that we are seeing within the tax world. But again, everybody's tax situation is so unique that you can't make any decisions based on what you hear in this webinar. You should definitely give us a call so that we can look at it based on your personal tax situation. And this is like a lot of times, if you're talking to us in Feb or March, it's already too late. There is only a limited amount of things that you can do to manage your effective tax rate after December 31st. So I'll just say, just give us a call now. This is probably the best time to talk about it.
Mary, Kevin, anything else?
Oh,
I think the only thing I would add, Mary made a great point about the Roth. I think that's something that, not only from a retirement vehicle, but also for a wealth and estate planning vehicle, it really has a lot of attraction. So if you're in that range where you can take advantage of that and do an IRA to a Roth conversion, it's really worth looking at.
Super. Well, again, thank you. On behalf of Stowe and Deegan, we appreciate everyone for attending today. If you have any additional questions, just reach out to your contact at Stowe and Deegan, and we will get back to you with answers. As I said, you'll be getting a survey shortly. If you could take a couple of minutes and fill that out to tell us how we did today and to suggest further topics for us to discuss in the future, that would be greatly appreciated. And again, this program is being recorded, and in another day or two, you'll be able to find it on our YouTube channel. So on behalf of the firm, thank you very much for attending, and we'll see you again in 2026 at our next webinar.
See you guys.
thank you.
Bye-bye.
Thank you.
Bye-bye.